How would you like to get 12% back on an ETF? Well, we found YieldMax Target 12 ETF funds. To secure your future, we're going to give you a comprehensive analysis of BIGY, RNTY, and SOXY, all from the YieldMax family. Hey, welcome back to the channel. I'm Doug, the retirement guy with all the monthly ETFs. We got a great video for you here today. Before we do that, I want to say this. If you're not a subscriber to our channel, boy, you're missing out. Welcome. Hit that subscribe button, hit that bell notification. Don't be afraid to miss out on any of our videos because all we're trying to do is put more money into your pocket. Let's get into today's video. Notice to all viewers, past performance does not guarantee future results. This video is for educational and informational purposes only and more for entertainment. The examples and suggestions discussed are illustrative and may not be suitable for all individuals, so please always consult a licensed financial advisor or a professional before making financial decisions. What is the Target 12 ETF funds that we talk about? Well, let's explain it to you. The issuer is YieldMax. Now, I know right off the bat, everyone's going to go, whoa, YieldMax, that means NAV erosion. Well, we're a little different here. It's an ETF family that focuses on option income strategies. The Target 12, which they trademarked, denotes that the fund seeks a 12% annual income or yield as the goal. The first Target 12 ETF came out as BIGY. It's the Target 12 Big 50 Option Income. It was launched in late of 2024. They have now added two more to the fund, so they have BIGY, RNTY, and SOXY. The funds are actively managed, and they're not pursuing passive or index tracking. It uses a blend of equity holdings and option strategies to try to produce that 12% income. What it is with the target and what's their strategy? Well, here's how the fund adapts and attempts to achieve its objection. 1. Equity portfolio. The Big Y invests directly into a portfolio of 50 large U.S. companies. That's why they call it the Big 50. Those stocks have significant liquid option markets. Okay? That means they have cash out there. They are the big ones. They're paying dividends, which is going to help get to that 12%. The portfolio is reviewed and adjusted quarterly to ensure the holdings meet the criteria: liquidity, option availability. So they want to make sure that they can go ahead and do what strategy that they have, selling options, making sure the funds have some volatility, and they have liquidity into the package. Options and option writing. To generate income, the fund writes sell options, typically on underlying equity holdings. The premium earned from those selling options adds to that cash flow. So you're getting dividends from the companies plus the income from the selling of the options. The strategy may involve different option strategies tailored to the market outlook. What does that mean? You may be selling call options. You may be selling put options. Even sometimes they look at things at doing possible swaps. So what they're really watching for is what is the market doing with each one of these 50, and then they try to make the changes accordingly. How each fund works. Well, we're going to start off with the Big Y because that's the oldest one in the package. And the Big 50 strategy is that they're finding the underlying assets of 50 large cap U.S. companies. The covered call options on those equity holdings. The income generation comes from collecting the premiums from the selling of the call options while holding underlying stocks. So they actually are holding and buying the stocks of these 50 companies, which also gives them a return on dividends back into the fund. Now, it does limit the upside potential in exchange for consistency of income. And you're going to see that with option trading is that your upside is normally capped. Now, the second fund that they have is RNTY, and that is a real estate focused fund. Underlying assets is U.S. real estate companies, REITs, and real estate stocks. Okay, I love REITs. I love the real estate. It's very focused for me. So here's a fund that we can get into that is all about real estate. Complex option strategies on real estate securities. Income generation, option premiums, plus underlying dividends from real estate companies. The trade-off, the sector concentration risk with the real estate market is exposure. So what they're saying here is you got to remember the first big Y is 50 different companies, 50 different markets, 50 different entities. Now we're going to go all in on real estate. Focus on real estate, real estate, real estate. So if real estate goes up, we're probably smiling. If real estate goes down, we're probably crying. So there's a kind of a thing is you got to know what you're getting into with these funds. And the final one is going to be the semiconductor play, which is SOXY. This one's going to have 15 to 30 semiconductor companies. It's going to give the options overlay on semiconductor equity positions and the option premium collection from those volatile tech sector, the high volatility sector with significant growth potential, put income strategies may be capped. So again, explain this in layman's terms. Semiconductors have a huge opportunity to grow. With high volatility, which is what you want volatility in a day, up, down in a day. That's where you're going to generate income. That's where you're going to generate the dollars and cents. But here's the other thing. If this is such a potential growth segment that you may see more growth than you see on income, even though it's capped, they still have that much power in the semiconductor program. So let's take a look at each one of them a little more detailed. This one here, the YieldMax Target 12 Big 50 option. We've just explained this is the Big 50 cap. It was launched in November 20th of 2024. So we're about 9 months into this right now. It has assets under management of 10.53 million. It has only 200,000 shares outstanding. So I think one of the big things with this fund is that a lot of people don't know about them. I think this is probably one of the best kept secrets that's out there that no one really knows, and that's why we're seeing these kind of numbers. Now it does pay out monthly. I know a lot of people are excited about weeklies and all that kind of stuff, but monthly is not bad either. So let's take a look at this one. The year-to-date return is 15.20%. That's not bad. The current yield, and that is your dividend, is 11.65%. Right where they're telling you. We got 3 months to go to get to the 12%, so it should not be a problem. And they're at 97.1% yield achievement. So the risk factor on this is moderate. You're going to get moderate because you're in an option trading industry, but you're using the giant 50 large cap companies. So it's not that there was anything scared about the portfolio, but we have to worry about options as a whole. So it's really telling you that it's a fairly smooth, safe package with understanding options. Now let's take a look at the real estate action. Now this one here launched in April 16th of 2025. The assets under management are only $2.5 million. So this one here, I know it's only, what are we at? Probably about 6 months into this one. Probably 5 to 6 months into this. So having 2.53 million in that short a period of time is not a lot of money. I'd like to see this thing get more to that $5 to $7 million mark. So I'm a little concerned about the assets under management because you need the assets under management to generate the income, to generate the options, to do a lot of stuff behind the scenes. It only has 50,000 shares out there. So that's another reason why you only have $2.5 million outstanding. The monthly pays out monthly on a regular basis. Now let's take a look under the hood. Year-to-date return, negative 1.19%. Well, this is not good at all, guys. I hate to tell you this. The current yield, 12%. So they've generated great income. They've already achieved their achievement. They're probably going to go over that top. So they've made the 12%. But I keep always trying to express to everybody, this is like taking money from one pocket and putting it in the other pocket and losing 1.19%. Okay, you can sit here and say, I'm making 12% dividend, but because you've lost value of the fund, you have to deduct the the difference of your losses. So this thing here, 12% dividend in, but you're losing basically 13% of net value. So this one has a really risk high value. Portfolio is high because you're dialing into options and only into one category, which is real estate. Now, I am a firm believer. I love real estate, and I do believe real estate is going to be a very strong piece here in the end of the year and probably into the first of the year, because if the more the interest rates drop, the more we have adjustments in that factor, we're going to get people buying homes. We're going to have people either refinancing, buying new homes, doing a lot of work in that segment. But if this is what they're getting out of it, this is not where I would want to park my money, because I need, on this thing, I need the income. And so that means I got to have either zero growth or positive growth, not losing 13 and getting 12. So let's take a look at the semiconductor option income. This one launched in December 2nd, 2024, so shortly after the Big 50. Has assets under management of 7.26 million. Yeah, again, not bad, but not great. This thing is only maybe a month older or younger than the Big 50, so I would say this thing should be closer to the $10 million mark. So another question mark for me. 125,000 shares outstanding, and again, pays monthly. Let's take a look under the hood. Now here's what I'm talking about. 24.91% year-to-date return. Okay, remember, year-to-date return is going to be your dividends plus the growth of the fund. The current yield is 7.56%. So the yield that we're doing with, not bad, but it's 63% of the yield. So they have 3 months to make up the 4%, almost 4.5% they have to make up. So it's a positive 7.56 because I love the growth, but we're not getting the yield. So the question I throw out to everybody watching this is, what do you want? Do you want income? Do you want growth? Or do you want both? And it's okay to say you want both. But here's what we got. 24%, if you're saying this is 24%, it's great. That's growth, not income. Because if you try to get that money out of it, you have to sell shares. So what I'm trying to say is, you want the 7.56% is your income. The rest of it's growth. The only way you get that growth in your pocket is by selling shares. It can be done, but I'd like to get this thing at 12% and have that big growth as well. So I want both the cake and eat it too. Now this one again is going to be high in the risk factor because you're into one category, semiconductors. You're also selling options trading. That raises the bar. But overall, if you do it right, if they do it right, because you don't have to do anything with it, it should be a solid package. Let's take a look at the visuals on the performance, and we can see here, very simple, just putting in a bar chart, 15% from BIGY, 25% from SOX, and we're actually negative on RNTY. Same thing with the dividend yields. BIGY, well within the range. They're going to hit that range with no problem. RNTY, it's already hit it, should go well over it. And then SOXY is not generating the income we want, but they're generating the growth. So there's a kind of a trade-off right there. Can they get to it? Probably, but I'm going to put this thing probably more like a 10% income with a huge growth. So dividend payment analyst, and here's what we look at. And this is what I look at different things too, is when I look under the hood of a fund, how consistent do they pay? And these guys pay right on track. Very, very consistent. You look at it, I can quickly tell you an average across the board is about 50 cents. So each fund's going to pay you about 50 cents per month per share. That's not bad. That's a pretty decent income for a monthly dividend stock or dividend fund, proper wording. So when we take it down to it, the BIGY is paid out $4.42 over 9 months. RNTY is paid $2.06 over 4 months. SOXY is paid 4.41% over 9 months. And here's the thing, consistency. All funds maintain regular monthly distributions. So these are the things that we look for. What are we getting in? We're getting consistent dividends. Are we getting growth? Yes, we are on 2 out of the 3. Are we getting what we want as of income? Yeah, we're getting almost to that 12% category on the big Y, about 7.5 on SOXY, but RNT is paying us 12%. And remember, you've got to count in that loss, so you're really not making anything. But the positive I'm going to give you on RNTY, the longer they go collecting more dividends, it can wipe out that negative 1%. So it's not going to be the big return. That's why I tell everybody when we look at these stocks, when we look at funds, what is your total return? That's the first number you should always be concentrating on, not the dividend numbers. So investment considerations. Let's start with the pros. High targeted yields. They're looking for 12% annually through options trading. That is obtainable. That is very comfortable. I wouldn't say it's not hard to do. I think it's very achievable by most funds. Monthly income distributions provide regular cash flow, professionally managed of a complex options trading system, and sector diversification across different market segments. That's what I love about that. You're into multiple different things. If you could buy all 3 and put them in one portfolio, phenomenal. You got the big 50, you got real estate, you got semiconductors, strong, strong, strong. The cons. Option strategies may be limited the upside potential during strong markets. That's what you're seeing in that real estate program. You're seeing it in the semiconductor. You're getting the growth on that, but you're not as much as you want. High expense ratios, 0.99, compared to traditional ETFs, which are pretty much from 0.5 and below. It is a little higher, but I'm not shocked at that because of the options trading strategies. The sector concentration risk. What is this and what does it mean? It basically means that you're going after one segment. If real estate's down, RNTY is down. If semiconductors is down, SOXY is going to be down. If either one of those are up, you should gain the positive to it. Not 100% because it's going to be capped, but that's what they're worried about. Versus the big 50, you have 50 different companies. And maybe they're in, say, half of them, 25 different categories. The odds of 25 different categories falling at once, very, very low. And that's why they have that. So it's a better strategy across the board. Complex strategies may not be suitable for all investors. Okay? The question is, are you going to be able to take the roller coaster ride? Are you going to be able to take the volatility of the big ups, the big downs, the flatness, all over the place? Are you able to handle that? Are you going to pull up your portfolio and look at it and say, today you're down 12% and tomorrow you're up 5%? Are you going to be able to handle those? That's what we talk about. And then yield achievement varies significantly. When we look at SOXY at 63% and RNTY at over 100% already, these are some of the things. We're going to say they're consistent payers, but we don't know if they're consistent 12%ers. So I just want to put that warning out there.
Thank you for watching. Press the like button, hit the subscribe button, and join. Leave any comments below and join our Patreon to support the channel. I'm Doug, the Retirement Guy.